this doesn't mean that the ultimate result won't be different than in the past, which is to say, I've been expecting a sharp corrective pullback that would lead to the next leg higher. Hello, and welcome to another bi-weekly edition of the podcast I do for Arcadia Economics. My name is Dave Kranzler, and I wanted to talk a little bit about what's going on in the precious metals sector right now in terms of the shorter term trading. But first, this episode is brought to you by Silver Viper, which can be found under the tickers VIPRF on the OTC bulletin board and VIPR.V on the TSX. It's currently trading at 12 cents a share in US dollars, and it's actually up about 100% from the low it hit on March 15th. This week, it announced that it was upsizing a unit deal that it's doing. It's going to raise roughly 3.3 million in Canadian. The deal was upsized due to the strong demand. I mean, the stock is extremely undervalued, in my opinion. Proceeds will be used to advance its La Virginia project in Sonora, Mexico. The market cap of Silver Viper is $15 million in US dollars. And this is versus a total estimated silver equivalent resource of around 27 million ounces. And I'm using a gold silver ratio of 80 to calculate that. That's not the company's number, it's my number. The resource is a combination of open pit and underground. The open pit gold equivalent, because this is a silver gold deposit, the open pit gold equivalent grade is higher than the average grade for your standard open pit gold mine in the Carlin trend, which to me is rather impressive. Wanted to just show you some numbers so you know I'm not making it up. Here you've got roughly a little over 400,000 ounces of total indicated and inferred gold resource. Again, these are estimates, and roughly 19.8 million of silver ounces in the resource. So, and that translates into roughly 27 million ounces of silver equivalent. So at any rate, you're paying basically at the current price, roughly 55 cents per silver ounce in the ground, which is absurdly undervalued in my opinion. As most of you know who own the junior microcap project development stocks, they have not really participated in the rally that we've seen go on in the sector since the fall of 2022. But they are starting to catch up a little bit. As I referenced, Silver Viper's practically doubled in the last, call it 5 weeks. So I recommend Silver Viper in my mining stock journal, and it'll require some patience because it's a project development company. But I think in the end, you'll be very happy if you spend the 12 cents US to buy some shares at this level. So today I wanted to discuss a trading attribute I've noticed for gold and silver that I haven't noticed in the past, especially after the sector's had a huge run up like it has basically since the beginning of March. And I checked with a couple colleagues who have been around as long as I have to make sure I'm not on drugs. And they agree with me. Now, this doesn't mean that it's the ultimate result won't be different than in the past, which is to say, I've been expecting a sharp corrective pullback that would lead to the next leg higher for about a week and a half now. And the sector's either continuing to move higher or maybe it's starting to trend sideways right now. And I base my observations on some trading patterns, and this will be kind of chart heavy. I apologize for the crude nature of my graphs. They're not nearly as nice as my colleague John Titus's are last week, but it is what it is. So I think the sector, as everyone has probably noticed, is technically extremely overbought right now. That doesn't mean it can't stay overbought for a long time. And the sentiment indicator that I like to use and is usually reliable in the past, the Holbert Gold newsletter stock index has gone up into an area of bullishness where historically there's always been a correction or a big sell-off that follows at some point. It doesn't do a good job of telling you the timing of that sell-off or correction, but if we don't get a sell-off or correction this time, it would probably be the first one that I've seen it get as high as it got recently without having a sell-off. So let me start with the charts. And in terms of just showing you the degree to which I think this thing has gotten overbought technically, and this is the move in silver. It's been the most extreme or the sharpest move since the beginning of March. And I mean, this, if it keeps going like this, either the entire global financial system's in big trouble and we're going to Mad Max territory, or we're going to get some type of correction. And it could just be a sideways correction. I mean, as you can see, it's kind of started sideways here. And in the meantime, I like to use the RSI and the MACD as simple, basic technical indicators. And it's obviously had gotten extremely overbought from very oversold and starting to roll over a bit. If I had a chart of GDX, you'd see that the RSI is actually heading south. Now, again, that doesn't mean that the market's going to continue heading south or start to head south from here. We could easily work off this overbought condition by just going sideways. And I think that's a very real possibility. And that also would deviate somewhat from when we've had this type of setup in the past. I wanted to show the volume here because the volume has come off quite a bit as silver, which I'm using SLV as a proxy, has kind of gone sideways. So this could be a positive. I don't know. Time will tell. So I wanted to just run through some short-term trading charts in gold and silver to show you what I mean. I mean, these guys have had a hard time, and there's been several attempts since the beginning of April to push gold back below 2,000 and silver back below 25. And that's where I'm saying, and that's where I've kind of been thinking that the trading pattern might be different this time, because in the past, usually what happens is they'll start hammering gold and silver in the COMEX in the paper market, along with on the LBMA, which is also a paper market. You've heard plenty of rants about that. So I want to just show you, this is a 15-minute interval chart of gold for today. And you see we kind of went sideways for the balance of yesterday. And then shortly after midnight, gold goes right off a cliff. And I'm not sure if the Asian markets in general sold off. I should have checked. But at any rate, gold sold off, and it intensified around the time that the LBMA fix occurs, the AM fix, which is standard procedure. And it went all the way down to a little below 1982. And this is, just for reference, this is a June gold futures contract. And then boom, it bounces right back up over 2,000. This chart shows, this is just essentially over the last week. Again, it's June gold, and it's on an hourly basis. And I just wanted to show you that there's been a couple attempts just this week, starting Sunday night and Monday, where they tried to push gold below 2,000. And again, it popped right back up. It's kind of like one of those punching clowns where you punch them and they pop right back up. And then this is gold, the hourly chart of June gold for the month of April. And you can see ever since it popped above 2,000, this was toward the end of March and at the beginning of April, there's been several attempts over the course of the month to date to get gold below 2,000, and so far it's failed. So we'll see. Similarly with silver, this is today. It's a 15-minute chart. Similar pattern as gold. Whoops, right below 25. And then boom, right back above 25. And this is about where it's trading as I'm recording this on Wednesday, midday Denver time. And here's the weekly chart. And silver's actually been stronger than gold on a relative basis. The gold silver ratio has gone down a bit this month. And I'll discuss in a minute some of the reasons why I think this may be the case, as well as why I think it may be the case that they're having trouble manipulating the price lower for now. But at any rate, they didn't get silver back below 25 until Monday. And you see it's, I mean, they did manage to get it below 26. You know, this is, it's not just the banks that are dumping paper contracts here. This is hedge funds that chase momentum, and they have sell stops or stop limits set up at key technical levels, and one of them happens to be 26. And the banks get the apple cart rolling downhill, and then the apple cart tips over, and boom, you get this. But they didn't get it below 25 and until Monday, and it was very brief. And we popped right back up. Whoops, back below 25 today, almost down to 24.70, and then boom, a 63-cent spike. You know, again, it's like right now they're trying to hold that proverbial beach ball below the water. So we'll see what happens, how this plays out. I mean, historically, when we've been in this technical setup after a big run, they just keep pounding it lower and lower and lower in stair-step function. And there is a chance that this could be kind of a stair-step function, and we're going to go below 25 and below 2000. No one knows for sure. But again, like I've said, I haven't seen the metals this resilient over almost a month-long period as they've been since the big run-up that I demonstrated in that chart of SLV. So in that, it might be different this time than we've seen, at least since I've been doing this over the last 22 years now. Wow. I wanted to just discuss a couple factors that might support the argument that it could be different this time. Again, we won't know until we know. But the first one is, and I'm sure everyone's aware of this, there's been an enormous demand of physical gold from the Eastern Hemisphere central banks. According to the World Gold Council, an all-time record amount of gold was imported by a multitude of Eastern and Southern Hemisphere central banks. And the February report that I saw reference to said that the rate of buying continued in January and February. So I've always kind of thought that, notwithstanding their ability to push the price around in the paper market, COMEX and the LBMA, that eventually demand in the physical market would create pressure from below the paper and start pushing the market higher to a point where they would start to lose control of their ability to push the price down using paper. And again, we'll see if that's the case this time around, but there's obviously a lot more physical gold demand than we've seen historically. Silver as well. Just wanted to share this graph from our good friend Craig Ferguson Hemke. And I happened to notice this today on Twitter. I actually saw the report this morning. According to the Silver Institute, in 2022, there was a supply-demand deficit of silver of 237.7 million ounces. So what that means is that if you take all the silver that is supplied annually from mining and also from recycling and measure that versus the demand for silver, there was more than a 250 million ounces in deficit. And again, as I'm sure most of you are aware, most of that silver came from the vaults in the LBMA, and a lot of that silver went to India. I can't remember if it was a record amount that India imported in 2022. I think it might have been. And I'm guessing that they're their demand has continued into this year. Similarly, in this country, there's been, as has been widely publicized, I mean, we've seen the spreads on silver bullion coins blow out, particularly American Eagles. But it's not just confined to the Eagles. And it tells us that from the retail side, which is your primary, at least in the West, your primary consumer of physical silver, there's been an enormous demand and a growing demand of silver for silver bullion versus supply. So I think that could be one of the factors that's giving them even more trouble trying to push down silver than they've had trying to push down gold. Second is central bank monetary policy. And I think everyone is starting to realize that at some point the central banks are going to have to reverse their tightening policy and take rates lower. And we saw a hint of that with the SVB and Signature Bank blowups, and with the Credit Suisse demise. The Fed and the Treasury really did not take very long to decide that they needed to print a few hundred billion to make sure the banking system stayed intact. So to me, the banking crisis isn't over. If you want to see why, you can look at the video I did with John Titus 2 weeks ago on the Arcadia YouTube site. But the banking crisis is just getting started. And at some point, and again, I don't think it's going to happen in the next couple Fed meetings, but I think at some point they'll stop hiking rates. And I think it could get so ugly in the financial system that we'll see them start to take rates lower and start really printing a lot more money toward the end of the year. And that obviously is hyper bullish for gold and silver. And then just quite simply, I mean, there's a much wider investor audience in the precious metals sector than there was when I started back in 2001, or even when we hit a cyclical bull top in 2011. And we basically, they blamed it on supply shortages or the pandemic or whatever, logistics. But there's probably been a shortage, more days since the March 2020 lockdowns. There's been more days of silver shortages and higher premiums than we've seen at any point over the last 22 years since the bull market started in 2001. So, for me, I actually have been, whenever I see specials on any of the bullion dealers, I tend to take advantage of that and buy more physical. In fact, I just had another delivery of silver Philharmonics this week. So will it be different this time? Are they going to fail trying to push gold below 2,000 and silver below 25? And we trend sideways for a while and then head higher? I guess we'll find out eventually. I think we'll find out within the next month or two. But to kind of conclude this, I wanted to share a chart that I prepared for my next mining stock journal. And this shows gold and silver from 2001 to present on a weekly basis. You've seen all different kinds of flavors of this chart. It became in vogue to talk about this cup and handle. Well, guess what? We're in the handle now. And, we could still get some sideways going this way for a while. Will we? I don't know. But at some point, and I think it's probably going to be when the central banks are forced to pivot to keep the banks from collapsing, the big banks, the G-SIBs, I think we're going to see gold and silver do another one of these. So my thesis on this chart is that we're in a secular bull market that started in 2001. We had the first bull cycle that lasted from 2001 to middle of 2011. Then you had a short bear cycle, although it didn't feel short relative to the up leg, that lasted about 4.5 years until the end of 2015. And we're recovering. We've recovered back to where we were at the top in 2011. And now we're going sideways a bit, marking time, just waiting for the next bombshell from the central banks or the geopolitical situation to drop, and boom, I think we go off, and I think we're going to have, I don't know if it'll last another 11 years, but I think we're going to have a move that will make this look small in comparison. So that's it for this week. And until next time, 2 weeks from now, please don't spend all your time watching the markets and on social media and getting into fights and Twitter. For God's sakes, go out and enjoy the spring weather.